All right, let's jump straight into this. Welcome to This Explainer, where we're going to unpack what is honestly one of the most dangerous, kind of mind-bending paradoxes in all of business finance. You know the story, right? You hear it all the time. A company is absolutely booming. Sales are through the roof, margins look fantastic, and then boom. Suddenly they're closing their doors forever. So how on earth does that actually happen? Well, today we're looking at a pretty stark reality. Profit is not cash. We're going to map out exactly why totally profitable businesses can and do completely collapse.
So I want you to start by just thinking about this central mystery for a second. Why do profitable businesses collapse? It really challenges the most common assumption we all make when we look at business. We just naturally assume that profitability guarantees survival, right? Like if the money you make is greater than the money you spend to make it, you're safe. Makes total sense. But it's wrong. In fact, relying solely on that assumption is exactly the thing that leads so many leaders right off a financial cliff.
All right, let's get into Section 1, Paper versus Reality. This is all about the massive divide between accounting and actual money. So here's what that divide looks like in practice. On one side, you've got your P&L, your profit and loss statement, which just shows performance. It tracks your revenue, your gross margin, your net profit. Think of it like a scorecard. But then, on the other side, you have cash flow. And this is reality. It tracks the actual physical money received, the money paid out, and the literal bank balance available to you right at this exact second.
Now, as I'm sketching out these points, keep in mind that the P&L is entirely accounting-based. First off, revenue is recorded when it's earned. The very second you make a sale or send an invoice, boom, it goes on the scorecard as a win, even if that money isn't actually in your hand yet. And second, expenses are recorded when they're incurred. You get a bill and it immediately hits your profit margin on paper. But again, no actual cash has necessarily moved yet. It's just a paper reality. But let's write down what actually matters, because here is where the rubber finally meets the road. Paper profit absolutely cannot pay your bills. Only cash does that. Salaries, suppliers, rent, loans, day-to-day operations. Look, you literally cannot hand your landlord a beautifully formatted profit and loss statement, and you sure can't pay your employees with gross margin percentages. They require actual cash. If all your revenue is stuck in unpaid invoices, your performance looks amazing, but your reality is that you have absolutely zero cash to pay for these critical things. Which brings us to Section 2, the hidden cost of growth. This is exactly why profitable firms fail.
Look, growth requires things, and as I list these out, you'll see how they act as massive drains on your cash reserves. First, more inventory. To sell more, you literally have to buy more raw materials or stock up front. Second, more credit sales. To win those bigger clients, you're usually forced to give them, 30 to 90 days to actually pay you? Third, higher expenses. More staff, more software, bigger marketing budgets. And fourth, debt repayments. Lenders absolutely want their monthly cut from the money you borrow to expand. Every single one of these things requires cash today. But that revenue, it might not arrive for months.
So, you end up with this incredibly dangerous disconnect. You've got profit on paper, but immense pressure in the actual bank account. The business is growing, the P&L looks like a hockey stick just shooting up and to the right. But the bank balance is at absolute zero, because every spare cent is tied up in inventory and unpaid invoices.
And that leads us straight into Section 3, Fatal Emotional Decisions. This is where we look at the absolute biggest mistakes management makes. The biggest mistake leaders make during a cash crunch is reacting emotionally instead of logically. It almost always starts with this mindset. Sales are growing, we're fine. They completely confuse top-line ambition with actual cash stability. They see revenue earned on the P&L and just kind of assume the cash is going to magically sort itself out. It creates this wild, false sense of security while the ship is literally taking on water.
Which usually triggers the next emotional reaction: buy more stock. Because sales are growing, right? So the knee-jerk reaction is to fulfill that demand at all costs. But they make this huge decision without even checking if the bank balance can actually support it. Buying more stock just drains whatever cash reserves are left, basically converting your liquid survival money into a bunch of cardboard boxes sitting in a warehouse.
And then, when the cash totally runs out from buying all that stock, the panic sets in, and you start hearing this: take another loan. This is such a perilous habit, just papering over a cash flow shortage by blindly taking on more debt. Sure, it solves the problem for, a week, maybe a month, but it adds even more mandatory cash strains to the business down the line in the form of future debt repayments.
And finally, out of this totally desperate need to just keep the growth story alive, management says, give more customer credit. They want to secure that sale on the P&L so badly that they offer these super generous payment terms to the customer. But doing this actively starves the business of the cash it desperately needs today. You're essentially acting as a free bank for your customers while your own business is suffocating.
Make absolutely no mistake about this. Making these kinds of emotional decisions without looking ahead means that risk is building silently. You don't see the collapse coming because your P&L is sitting there telling you that you're a profitable, successful genius. But that risk just compounds in the shadows until the day payroll is due and the bank account literally reads zero.
Okay, so how do we fix this? Section 4, the Smart Business Playbook. Let's look at what the pros actually do.
I'm going to list out the 5 steps of the ultimate defense mechanism here. Step 1. A weekly or monthly cash forecast. Smart businesses look into the future of their bank account, not just their past performance. Step 2. Tight receivable collection. They aggressively collect the cash they are owed. Don't be a free bank. Step 3. Controlled purchasing. Buying is based on what the cash flow can handle, not on emotion. Step 4. Working capital monitoring. They are constantly watching the balance of what they owe versus what is actually owed to them. And Step 5. Separate profit versus cash reviews. This is huge. They hold entirely different meetings to look at the P&L and the bank balance, treating them as 2 completely separate forces.
Which brings us to our final truth for this explainer. If you take literally only one thing away from our time today, please let it be this exact phrase. Revenue is ambition. It's what you hope to achieve. Profit is performance. It proves your business model works on paper. But cash is survival. Without it, the other two simply do not matter. So, I'll leave you with this. Are you managing your ambition, or are you managing your survival? Really think about that as you look at your own numbers this week.